Good evening. Welcome to the I've already recorded one video on funds transfer pricing, but I thought that it was not really subsequential. So I had the first part, which was about what is funds transfer pricing, how we can, how the profit allocation between asset center, liability center works, and what is in the central level unit going on. So how the risk transfer between asset and liability center is going. However, I think that I would like to record the sessions where we have a bit more order. So the first video, 15 minutes on funds transfer pricing, part 1, 2, 3, and it will be basically subsequential. So you have one video, then the week after another one, and so on and so forth. So there is a bit more order in this. So even if I repeat the same, maybe which I've already recorded in my video number 1, for the sake of order, I would like to include this part as well. So this is the series of main topics on funds transfer pricing, and I think that I would like to highlight all important aspects. What is FTP in banking and how to, approach it, because there are different approaches, especially as comes to the FTP curve construct, as comes to the FTP methodological aspects for NMDs, for example, also non-maturing deposit, or how to price loans which are subject to credit events such as prepayments, for example, or defaults, and how to deal with this. So let's start. What is funds transfer pricing, first of all? Obviously, here we are talking about financial institutions. So in specifically, we are talking about mechanism and processes, because it's not one concept. FTP is the selection of different concepts. So first of all, we have the FTP curve, we have the FTP methodologies, we have the FTP landscape. By FTP landscape, I mean all products which are subject to FTP rate. And then we have the target operating model, because this is such a strategic mechanism within the bank that, if mismanaged, could lead to potential problems such as incorrect shaping of the balance sheet or undesirable behavior in terms of the balance sheet. So it is a strategic tool, as I said, because it can shape the whole balance sheet. So as already mentioned, there are different elements. Let's start from the process. So usually you have a number of stakeholders which are involved in the FTP process. However, those who are directly impacted by the process are, of course, business unit and the central unit. Just wanted to clarify one point, that by the central unit here, I will be using interchangeably the term ALM, Asset Liability Management Department, or Treasury Department. It's not always the case. Sometimes ALM is under Treasury, sometimes it's not. So in this particular presentation, we will be referring to ILM and Treasury interchangeably, the term interchangeably. So basically, we are saying it is the same department, or ILM is within Treasury department. So we have business units, ILM, Treasury, and of course, each business unit has its own objective. Asset center is supposed to originate products to the customers in terms of loans. So we can say commercial mortgages, retail mortgages, car loans, asset finance loans, a number of products on the asset side which are originated for customers. And of course, they are consumers of liquidity because liquidity is lent on to the customers. So basically, these products are providing liquidity to customers. So therefore, we are talking about this business unit as liquidity consumer. And of course, in FTP process, nothing is for free. Like we used to say, in FTP, no free meals. That means that, of course, given that they are receiving liquidity from the central unit, from ILM or Treasury Department, therefore they have to pay for this. And the price for this liquidity is FTP rate. So FTP is a benchmark for the specific institution in terms of the price or charge for the liquidity which is provided to the business unit. However, there is, if we are providing liquidity, it means that from the other side, we have to gather it from somewhere. And in this particular case, we have the liability unit, and liability unit is responsible, is in charge of providing funds to the bank. And in form of FTD, so fixed term deposit, in terms of the NMDs, non-maturing deposit, in terms of many products which are belonging, notice account, for example, which are belonging to the liability side and as sources of liquidity to the bank. So therefore, they are responsible for gathering this liquidity. But as already said, given that they are providing liquidity to the bank, they have to be remunerated for this activity. And as such, they are remunerated or they are recognized the liquidity value from the central unit in terms of the FTP rate. So the FTP rate is being paid to a liability center because they are providing funds and is being charged to the asset center because they are consuming liquidity. So you can already see that there is, this kind of flow of funds from a liability center to the central unit and from the central unit to the asset side. So let's have a look at the example. So you see that the same asset unit, let's imagine, is originating 2 years loan at 11%. 11% in this particular case represents the all-in rate, or we used to say all-in customer rate. And it is charged, this loan, of course, the business unit, the asset center is charged FTP rate for 2-year funding. Why 2 years funding? Because this asset is consuming liquidity for 2 years. So as the principle of this central approach, or we used to say in the FTP rate, maturity matched FTP, where we have the central unit and we have like matching terms at the business units, because in this way we will be transferring the risk from the asset side and liability side to the central unit to be managed. Therefore, we are allocating or charging the 2-year FTP rate for this particular product. As such, we already said that it has to be matched. So we have the 2-year loan against 2-year FTP. And as a result of this process, we have the difference between 11% and 8%. 8% is at the FTP rate. And the difference is 3%. So the 3% represents the commercial margin to the business unit for lending for the loan. And it is locked in. If you notice it, it is locked in for the whole life of the product, because of course we matched the tenor of the loan by matching the FTP rate to this product. So there is no mismatching at the business level. So there is no risk. There is no liquidity risk. There is no interest rate risk, because the transaction has been matched, internally matched. Like this is like fictitious hedge at the between the business unit and the central unit. In this way, as you see, they are charged FTP rate, and they are, of course, in this way we are transferring those risks which are driven by the transaction, liquidity risk. This is 2-year loan, so this is longer term asset. Therefore, there will be definitely exposure to the interest rate risk, and those risks are automatically transferred from the business unit to the central unit to be managed. At the same time, on the liability center, we have similar situation but with the opposite sign. So the deposit unit is originating 3 months deposit. Let's imagine this is example. And let's imagine the cost for this deposit is 4%. So we are paying to the depositor 4% for 3 months deposit. At the same time, treasury unit is remunerating the deposit center with the 3 months FTP rate, because again, the principle of matching, the principle of fictitiously hedging this position is the same like in the asset side. Therefore, we are providing here the FTP rate for 3 months FTP rate, and the business unit, the deposit center, has the profit, which is determined by the difference between 6% and 4%, which is 2%. So we have a spread at the deposit level of 2%. And this is fixed for 3 months. This is profit which is fixed because there is no mismatching, there is no risk. And the risk has been transferred from the liability center to the central unit to be managed. Indeed, let's have a look what's going on at the central unit. At the central unit, we have a 2-year FTP, which is coming from the asset side because it has been charged. So we receive this FTP on the asset side. Therefore, for like mini treasury, mini balance sheet in treasury department, we have on the asset side this 2-year FTP at 8%, which is driven by the asset position. At the same time, we are paying 3 months FTP for a liability. So you have 6% FTP, 3 months FTP. And the treasury spread is 2%, is determined by the difference between 8% and 6%. However, there is one main difference between those two. As you can see, you have the exposure to the interest rate risk, to the liquidity risk. In treasury department, we have other risks such as FX risk, option risk, behavioral risk, basis risk. Here, of course, we are talking only about the liquidity risk, which is driven by the different tenors on the asset and liability side, and interest rate risk, because of course we are running interest rate risk. The asset is 2-year asset, which is founded by 3-month liability position. So there is maturity transformation, and maturity transformation is because we are lending long and borrowing short. This is how we call it at the ILM center. Let me stop here. I would like in 1 week to tell you now about treasury, what are the principles about treasury as a service center and as a profit center, but this will be for our next session. Thank you very much.